Wonderful. So good morning, everyone, once again. I think I'm kicking off this webinar with an introduction to new electricity structures. So please allow me to share my screen, or Jehoshaphat, kindly share the slides that we can kick off. So as mentioned, my name is Anna, I'm the CEO of GreenCo. Personally, I've been a project finance transaction lawyer for 15 years before starting GreenCo. So hopefully we as a team collectively can share some of our knowledge, and special thank you to the guest speakers for today's webinar from my behalf for joining us. Now, we are hoping to make this webinar as interactive as possible. At the moment, only the chat room is open, but please try and ask us as many questions as you possibly can, and we will also try to answer those. So please feel free to comment as much as you possibly can. So what do we see in the SADC market? And we hope that we are joined today by many local developers. This webinar is really open to everyone. However, it is really the local developers that we would like to invite and would like to share this information with. We understand the development of projects is often a very tricky process, taking into account the numerous bankability, reform, regulatory, and other requirements. And we are truly trying to share as much information as possible to ensure that the local developers get the same access to bankability of projects as do those international developers that might have more experience from elsewhere. The SADC electricity demand is something we should all really bear in mind. We are looking at an exponential demand rise up until 2017. It's projected to rise 8 to 14 times. It's now projected to move more closer to the 14 rather than 8 times. And it is now projected already by 2050 and not 2070, as the World Bank report that we quote here originally stated. The demand in DRC, Mozambique, and Zambia could surpass the current South African demand. So meaning that not only is currently the region experiencing significant difficulties, especially in Zambia and Zimbabwe, as we know, due to the El Niño's effect on hydrology, but we are looking at an exponential growing demand in the region, which is linked both to growth in commercial and residential demand, but absolutely also the mining demand. We can see the decarbonization of the world being reliant on the critical minerals coming extensively from a number of SADC countries, and therefore the requirement for new electricity generation will be substantial going forward. Now, what do we have as the current market model that it has predominantly been used to bring new generation on board in overall sub-Saharan Africa? We had a model whereby, and we still do, and this model is still relevant for certain projects, especially those that are very large in scale, where the IPP, the generator, sells to a state utility, and then that state utility requires payment support guarantee from the government fiscal. The reason why this is the structure that has so far been the only one to be considered bankable is because of the presumption, often correct, sometimes not correct, that the state utilities are not creditworthy. Now, that presumption has led to a requirement for the government payment guarantees in particular. There are some risks that the government should shelter, such as, in particular, expropriation, currency convertibility, etc. But certain risks, like payment, often has been shifted to the government as well. What has that looked like? Well, South Africa is the best example of that, because through this model, South Africa has successfully brought online a significant amount of new renewable energy generation, thousands of megawatts of new renewable energy generation in a matter of years. And that is indeed a success story. However, that success story has also been quite costly to the National Treasury of South Africa, mainly when the National Treasury of South Africa started reporting on the REIPP's contingent liability obligations. It was an overnight 36% increase in the overall contingent liability on the Treasury. Now, that's a significant fiscal impact that takes away from the government's ability to pursue other projects in health, in education, and other sectors that fall under the government's remit. Therefore, once the success of this model has been proven and incorporated, it is time to move on towards a more market-making models. This is especially within the fact of the extreme capacity growth that we have seen the SADC region as a whole will require over the next few decades. This is also interlinked, as I mentioned, to the overall global energy transition worldwide, which can really be optimized and utilized for the benefit of the continent, especially those countries that are rich in critical minerals, by attracting the capital required for new generation projects, because the dependency between the extractive sector and wider decarbonization global goals is now truly there. So for the first time globally, we actually have a synergy between the worldwide decarbonization objectives, the mining industry, and the renewable energy generation that is required to support the entire energy transition. So the current status we know, but the challenges are also pretty significant. A number of state utilities in the region are experiencing significant fiscal and other challenges. In addition, as I mentioned, the governments often lack the required fiscal space to guarantee all payment obligations of the state utility. So what are the new market structures and the reforms that we are seeing in the region lately? There's a number of them. The SADC region has been a very exciting region over the past few years to see it from the perspective of regulatory change. The market reform has been extensive. In 2019, Namibia finalized a new energy policy and introduced a new market structure called the modified single buyer, which effectively allows bilateral trade as between a generator, a trader, and the ultimate customer, and facilitates exports and imports from and to Namibia. Zambia followed suit in 2020, following significant work in 2019. The Electricity Act of Zambia was enacted, which signified the opening and foreshadowed the open access regime introduction in Zambia. And we ourselves were the first private sector licensee to be licensed under the new legislation. South Africa followed suit in 2022 when the president foreshadowed the complete liberalization of the sector and the new electricity bill, which whose entire remit was to introduce competition in the electricity sector in South Africa. And we are actually delighted to see that the president of South Africa has assented the bill as a couple of days ago on Friday last week. So we can now talk to you about the new Electricity Act of South Africa and the impact that will have on projects in that country as well. In Zimbabwe, ZESA announced a number of market opening initiatives, but Zimbabwe was already a country that did not stipulate a single buyer model and where a multi-buyer structure can be implemented under the current legislative regime, but has not fully done so as of yet. Now, what do we see are the benefits of the open access regime and in the individual markets, and how is that linked to regional integration and trade, which we see as a key way into which to de-risk the individual new generation supply and demand requirements. We can not only optimize it better through regional and power pool involvements, but we can also de-risk it. And by de-risking it, we are automatically making projects more bankable. And that word bankability is the one that's going to be this almost magic thread throughout this course and throughout these webinars that will end in December this year. Because all of us, whatever we may be introducing to the market, and by all of us, I mean the regulators, the power pools, the state utilities, the private sector entities, and the generators themselves, the IPPs, of we hope there are many of you in the room with us today, all of us have, whatever we may be doing, we have to structure it in a way that is bankable in order to attract the much needed financing to these projects. So going back to this slide, open access, we believe, creates a new market ecosystem that will facilitate more investment into new projects and generation, that will facilitate better integration of low carbon resources and that energy transition that I was talking about, and that will facilitate cost savings when we look at optimizing new supply and linking it to demand on a regional basis through a systemic lens that looks at not only national, but regional generation, distribution, transmission, current realities, and then future needs in order to future-proof any generation project that we are bringing online. We as IPPs, as generators, as state utilities. Without that systemic lens that looks at regulatory changes in each individual markets and how they link to the wider Southern African power pool and regional developments, as we sit in Zambia, soon we will be interconnected to the East African power pool. Without looking at all of that, we will perhaps not sufficiently anticipate the required bankability and other risk allocations that we have to think about, taking into account that any investments in new generation are a 15 to 25-year investment. The trajectory is long, so we all have to prepare accordingly. What is the future in terms of where are we heading? We, as individual players in the electricity sector in SADC, and we as individual countries, and then the region. We are looking at developments of overall wholesale power markets. To link that systemic lens that I discussed earlier in terms of planning the risk allocation with appropriate understanding of regulatory context in each country and risk allocation through the region, we have to see what power markets, how they have developed in other parts of the world. In particular, in our case, we focused on Ontario in Canada. Why? Many learning curves there from the perspective of the fact that Ontario has mostly dependent on hydro. So it brings its own risk allocation questions in mind when there is especially hydrological issues like the ones that have hit Zambia and Zimbabwe recently. And we looked at the market opening in India in order to see what precedents, what lessons learned can there be, because nothing can be copied and pasted. We need to learn from most of these countries and then contextualize it to the developments in the region. But there are some basics in terms of different roles of different players in an energy market. And we thought we would start this first webinar by explaining some of these basics before, and some of these common threads in all market openings before we go on to elaborate on which individual countries are doing what, and then how it all links to the wider region, to the connectivity through the SAP, and eventually the regional power pools connectivity between themselves. So what we have here are some of the key players, such as, of course, the system operator, which is probably the most important player under the new market openings and open access regime, because it is the one that manages the grid operations and ensures the grid stability. An example of a system operator, there are many utilities who currently take on that role, and they really are to be congratulated for keeping the system, especially in the light of current challenges, as stable as they possibly can. The transmission system operator is responsible for transmitting electricity through the high voltage lines, again, maintaining system stability. The market operator is the one that facilitates fair and transparent electricity trading in the market. So the key example of a market operator currently in the SADC region is the Southern African Power Pool itself. So the market operator within the SADC, which effectively facilitates and controls the behavior of any SAP member that trades into the electricity markets of the Southern African Power Pool. We have, of course, the national exchange and the regional exchange, which is also in this case the SAP. We have different balance responsible parties, which are going to be extremely important new market players, especially in countries that do not have sufficient hydrology in order to help balance the grid. And this is why a balance responsible party is going to be a key word when you look at the changes currently taking place in the South African context in particular. And then, of course, you have the traders and aggregators such as GreenCo, which engage in buying and selling of electricity, aggregating it across a portfolio of smaller projects and selling it either directly to customers, to the utilities, and or to a competitive market like the SAP. So these are the key players. And of course, behind them are production, yourselves, the IPPs, the generators, and the consumer. We looked at the node pool, and here I'm just going to introduce the node pool very, very briefly as a very good example of a very liquid, growing market in the Nordics. And we will have a special webinar session on the Southern African Power Pool and the node pool, and what lessons learned there can be, and how those lessons, most importantly, can filter through in concrete risk allocation in new project documentation, because that's really the reason why we are here, again, connecting to the bankability word. But here I just wanted to give a brief introduction to what the node pool is, just in case there are some entities out there that are not aware of some of the examples. So node pool operates in 16 European countries. It, as you can see, it has 360 customers. It offers day-ahead and intraday trading, and it's trading significant amounts of volume every single day. It's allowing for optimization of resources amongst Nordic countries. Some have significant hydro potential, others have solar and wind, and it's through the node pool, they're optimizing it to the benefits both of customers and the generators and the countries themselves from the security of supply and energy security perspective. So In terms of Nord Pool market reforms, when they really started among some of, as I mentioned, Nordic and Baltic countries. And they focused on not only energy security, as I mentioned, but on increasing that market liquidity and to facilitate the renewable energy integration. And that has done particularly through the ability of utilizing certain countries, such as, for example, Norway's hydrology to its best utilization possible to facilitate integration across the region of other renewable energy supply. The SAP, the Southern African Power Pool, now bringing it to the SADC context, is the most advanced power pool in Africa. We're delighted that we are members of the Southern African Power Pool. And again, in case we have some of the utilities attending, are absolutely grateful to them for accepting us as members and taking us to this stage. It was only possible through collaboration with the state utilities in the region, especially in our home country, Zambia. The SAP has operational different markets. It has so-called the bilateral market and the competitive markets. That's a distinction we want to make immediately because it's causing a little bit of confusion in the region. If you are a SAP, Southern African Power Pool member, such as GreenCo, you can trade in the competitive markets of the Southern African Power Pool, meaning the monthly, weekly, day-ahead, intraday markets at the moment. The balancing market is only for transmission system operators at the moment. However, even if you're not a member of the Southern African Power Pool, you can engage in bilateral trading, meaning that the bilateral trades are more longer-term trades, generally over a month long, where you can buy from a supplier, in general a state utility, and import it and trade it across the region to a customer somewhere else. So that's called bilateral arrangements in the SAP. There's 22 members of the Southern African Power Pools. Currently, the Southern African Power Pool is already leading ahead with introduction of future ancillary services and financial markets. And over 7 terawatt hours are approximately traded annually on the day-ahead market of the Southern African Power Pool. This is a little about the Southern African Power Pool market design, which is very, very similar to the design of the Nord Pool. And as mentioned here, it has some physical and organized competitive markets, such as day-ahead and intraday in particular, and in addition to the bilateral markets, which I already explained the difference of. As I mentioned again, we will have our power trading team in a few months lead a whole 3-hour seminar on the SAP, on its market design, and again, on how we bring all of that within the conversation around bankability and investment into new generation projects in the region, with a particular focus on Zambia and Zimbabwe. On this note, I will end my presentation, and I invite my colleague and Executive Director of GreenCo Zambia and Head of Business Development, Mr. Wezi Gondwe, to take over from this point. And thank you very much for listening until now.
Thank you very much, Anna, and good morning once again, ladies and gentlemen. And in this next section, we will just delve into the specific market structures that countries around the region that are adopting and evolving. As Anna had pointed out earlier, around about 2019, we saw, or from 2019, we've seen authorities and regulators in various markets begin to liberalize markets and adopting different approaching, albeit with similarities. So I will put up some slides now that will aid in this next section of the conversation. So I'll just take a moment to put those up. So we're going to start with a look at the market in Namibia. And this section is important because it then begins to inform us as to the mode of engagement that IPPs can have in the market, and specifically also the mode of engagement that GreenCo can have with IPPs in the various markets, in alignment with the current phase of their liberalization, and looking a little into the future as to the shape that might take. So in Namibia, beginning in 2019, the government instituted, and the regulator instituted what was called the modified single buyer model, moving away from the single buyer, having been non-power, and encouraging the introduction of competition by way of increased private sector participation, namely through IPPs. This was in recognition of the encouraging competition and the opening up in a phased approach of able to apply to become members of the MSB, as well as and become what's called eligible sellers, and consumers could also apply to then become contestable customers, with the ability to contract or procure up to 30% of their total requirement from third-party generators, with the MSB and non-power playing the role of the balancing party and supplier of last resort. And so this saw the rollout, the beginning of the rollout of the opening up of the market, with a tariffication of the services that were offered by the grid access services that non-power would provide. It also enabled those eligible sellers to also apply for export of power from Namibia. From July 2021, running through to 2022, is the phase E, phase 1B of the modified single buyer model. This entails a step down in the minimum threshold for consumers that can participate in the model, distribution consumers, from as low as 1 MVA of demand and upwards. This phase may also see the lifting of that cap of contestable consumers' ability to procure more than 30% of their requirement. Importantly for us is that this phase also then introduces and recognizes the role of traders in the market structure, and their ability to buy from eligible IPPs and sell directly to consumers, as well as to export and procure and receive system services from non-power under the MSB model. So this then was very exciting for GreenCo, in that it takes that step to introduce intermediaries that bring increased dynamism into the market, and options for both IPPs and consumers to interact with from a supply perspective, but also from a further risk diversification perspective. And then finally, we're looking at phase 2 in Namibia. This phase allows then for the inclusion of imports. As I said earlier, in phases 1 and 2, eligible sellers and traders can only export. Under phase 2, those eligible sellers and traders can also now import power. So increasing the mix of supply options into Namibia, and increasing the energy security, augmenting onshore generation with the added option of increasing power or importing power into Namibia. It also will see the lifting of that cap for eligible consumers to up to 80%, or rather beyond 30% of what they can procure from third-party suppliers, and aims to make Namibia a 80% self-sufficient in its energy requirements. Presently, Namibia is around about a 600 to 700 megawatt market in terms of total or aggregate demand, and does rely quite considerably on imports from South Africa and from Zambia as well. So the long-term plan is to reduce that dependency with onshore generation, but also maintain an element of import and export from the region. Moving on to South Africa, the model we see here is what South Africa has been over the years moving away from. We know that over the years, South Africa has taken a very successful procurement, public sector procurement program, the REAP program, from about 2010, 2011, that has seen about 6 gigawatts of renewables contracted, but that's all been on the back and the balance sheet of Eskom. And gradually we've seen private sector direct contracting between IPPs and consumers starting to emerge and take place. What is very exciting is the government has finally last week passed the Energy Regulation Act of 2024 that will now deliver the ultimate aim of opening up the markets and increasing competition by the introduction of a national market in South Africa. So this is called the multi-market model that aims to promote competition, non-discriminatory access to the grid, and increased flexibility and options for consumers in the South African market. So what we see there, as we already know, there's been an unbundling of the national utility with a national transmission company, which owns and operates the transmission grid infrastructure into a separate legal entity that will also then willpower on behalf of Eskom Generation and private generators and traders as well. The evolution of the market will see the introduction of a market operator that will provide balancing services and operate a day-ahead market, balancing services on an hourly basis that will in real time ensure that the supply and demand in the market is balanced. The migration to that market will also see the management of legacy contracts in the public sector for procurements that have been undertaken by the Department of Minerals and Energy, as well as by Eskom and REAP programs. Those legacy contracts being managed and transitioned into the competitive market model. But what we see there is consumers being able to interact directly with that market, i.e. purchase directly, subject to the eligibility to do so, as well as traders and generators being able to sell into that market. So this is kind of like full-on ultimate transparent and competitive markets that will basically see what have historically been physical contracts between generators and consumers, transition more into more financial contracts that are traded through or effected through a single national competitive market. And just to summarize, we've got this hybrid market structure that, as I mentioned, will incorporate and provide for a transition of physical and bilateral contracts, as well as regulated transactions, as mentioned, under the public procurement schemes, as well as private sector markets. And so South Africa, with the signing of this bill, I think really signals the culmination and transition of the single market, the single largest market in the region, into a full-on competitive market that will also have valuable lessons for the smaller and upcoming markets in Zambia, Zimbabwe, Namibia, to learn from and equally transition to fully open markets. Zambia will be the market that we'll touch on next, and at this juncture, I'll invite my colleague Brian Mwanza to take us through the recent changes, also equally exciting, that have been happening in Zambia, and the implications for how electricity trade and investment will be structured going forward. So with Brian, over to you, please, to run us through the Zambia section, please.
There have been further developments in the Zambian market, which are exciting for developers and entrants into the energy sector within the region, and in particular within Zambia. As Anna had highlighted, we are also focusing on those entities or those developers who would like to enter the Zambian market, both coming in from the region and those that are based here. So it's good that you have an understanding of what the Zambian market has to offer. In 2019, the government of Zambia did come up with a new regulatory regime in Zambia that moved away from a single buyer model where the national utility ZESCO was the only buyer and effectively the only seller from whom you can get power. But with that change in the law, a market has been created, or a regulatory environment has been created where there are multiple players, which essentially has moved away from a single buyer to a willing buyer, willing seller model. So we have had the Energy Regulation Act and also the Electricity Act come in 2019 that facilitates for multiple entrants into the market. Recently, in July, we had the open access regime, which then further gives clarity to the migration or to the process by which qualifying participants will be able to participate in this open access regime. One of the challenges that led to the amendment or to the repeal and enactment of the new law was that previously it was not very clear as to how other participants other than the national utility would participate. And even when the new act came into place, it was also not clarified as to the exact steps. But with the enactment of these regulations, now it makes it more clear and provides a bit more clarity. So it opens up the access to the networks that are available in the country, giving access to both traders, suppliers, system users, and consumers to have access to the national networks and be able to trade across not just locally, but also have access to the region. Now, there are two principal phases, or three, where you have bilateral agreements between participants, and there is also a system by which you would be able to have access to the region electricity markets and be able to trade on the open market. So to give you a bit more clarity as to what this open access regime in Zambia looks like, you have generators IPPs, existing ones as well as new ones, exporters, intermediaries or traders such as GreenCo, who are able to access the networks, the transmission as well as distribution networks. Anybody that trades, generates, or consumes anything above 1 megawatt of power is able to participate in this open access. So there's a threshold to access this market. These traders, suppliers, or generators and consumers can apply to a transmission or distribution service provider, for example, such as ZESCO in the Zambian market or Copperbelt Energy, where you would have access to the network in a non-discriminatory manner. The advantage of this new regulation that's been passed is that it also gives time frames within which these transmission or distribution network providers have to respond to an application. That is very important because timeframes are important for an entity wanting to get into the market to know how they will or how quickly they will be able to get a response from the system or from the transmission or distribution network provider to acknowledge that they've received the application, process the application, and within 30 days, give a response. Now, when the transmission or distribution network provider looks at the application, considers its capacity and, of course, financial capacity of the intended user, they're able then to decide to grant access to that qualifying participant. But before the participant has access to use the network, this is then forwarded to the system operator, who will have now the responsibility of handling the dispatching and making sure that there's non-discriminatory use or access to the network, looking at issues of congestion and verifying that information is provided by the system owner or system the transmission system operator or the distribution system operator, that the information they provide is accurate, and put it in the hands of a third party to give that oversight and make sure that there is non-discriminatory use, but also to ensure compliance to the grid code, which has been codified in Zambia, to make sure that all those that are getting access to the national grids meet technical as well as financial obligations that will make the system operate. Further to that, then the qualifying participant will then have access to the customer, or alternative to that, if it is the customer trying to get access to the grid, to be able then to be connected to the supplier. So it operates both ways, where you have a trader, a generator providing the power and then supplying it to a customer, or on the alternative, you have consumer who also consumes above 1 megawatt getting access to the grid to engage the traders or generators to have access to power to be able to utilize the grid infrastructure that is provided. So that, in a nutshell, is the new market structure in Zambia. In terms of the fees or the tariffs, the wheeling charges, these are to be agreed bilaterally between the users of the system, but are to be, there's regulatory oversight in those agreements by the national regulator, the Energy Regulation Board, to ensure that there's fairness, there's appropriate provisions put in those agreements, power purchase agreements, or power supply agreements, to ensure that there's features such as escalation clauses, dispute resolution clauses, and tariffs are well agreed to make sure that the system operates well. The tariff structure, the modalities of calculating those structures for the open access as provided in the new regulations, will be further clarified by the regulator to make it open and transparent, so that all participants will be able to be aware of what the charges are and not one entity favoring another in terms of the prices. So that is basically what the system has been designed to do. And the open access then gives you a clear approach as to the issues that are discussed in the Electricity Act as to how to then access the Zambian system without discrimination. So with that, I'll end my segment here. And then Ellie will take over from me.
Okay, so in the following section, we are going to take a little bit of a look at the sort of actual project side of things. So we'll start with a bit of an introduction to project finance. Then we'll discuss bankability and risk, and this session will be led by Orly, who you met earlier. Then another guest speaker, Vivek, from the Africa Infrastructure Development Association, is going to join and run us through the importance of the offtake agreement and or the PPA. And then we'll finish with looking at sort of risk mitigation via traders, such as GreenCo. So, introduction to project finance. So how are you going to finance renewable energy assets? Unless you have very deep pockets and can fund the project through, equity and your own cash, you will likely be looking at a project finance structure. And project finance is a way of financing that allows us to finance hugely capital-intensive infrastructure by borrowing money that will, one, be repaid slowly over a long period of time. Two, it's on a non-recourse or limited recourse basis, and I'll explain that a little bit later. And three, it's repaid only using the revenue or the cash flow from the project. So in the energy context, the loan will be repaid using the revenue from the energy sales. And this means that the lenders are looking at the ability of the project to repay the debt and not necessarily the company that is developing the project. And so the lenders will be heavily involved in the development and structuring phase of the projects, as they have a keen interest in ensuring that the project is bankable and meets their bankability criteria. And we'll touch on the concept of bankability a little bit later. What do we mean by non-recourse financing? And this is one of the sort of most important elements of project financing. And what we mean by non-recourse is the lender's recourse, or the ability of the lender to pursue assets of the borrower when a borrower defaults, is limited partially or entirely to the project company's assets. So the lender will not be able to pursue the parent company, nor will it be able to pursue any other assets of the parent company's group. It will only be able to claim back from the project company's assets. And it's probably useful to just sort of compare this with corporate finance or asset finance, which you might have been familiar with. So as mentioned, project finance, the lenders are looking to lend based on the revenue stream of the project rather than the balance sheet of the sponsor. But in corporate finance, lenders will be looking at the balance sheet of the borrower. So if you're a company wishing to expand, you might want to take out a loan. The lender will evaluate the credit strength of the entire business and take security over assets of the entire business. And similarly with asset finance, lenders are looking at the value of the asset. So the train, the ship, the plane. And obviously that's typically where the asset is a movable asset and can be easily sold. However, with project finance, obviously this is used for large infrastructure. The asset is what we call a stranded asset. It's very difficult, if not impossible, to sell a large scale or even a small scale, any sort of energy facility. And so the only way to really recoup that debt is through the revenue of an operating asset. So ultimately what lenders care about is whether or not the projected revenue of the project is adequate to repay the debt over the tenure of the loan, So will the energy sales at a particular tariff be adequate over 20, 30 years to repay back the debt? And that's a very sort of simple way of looking at it. Okay, so this is the standard project company structure. So if you are a developer and you're wanting to develop a project through project financing, you will, as a sponsor, it's a sort of a term we use for the developer, will typically set up a subsidiary company known as a special purpose vehicle, or SPV for short. And the role of the SPV is simply to develop, own, and operate the project. It has no other function. It will be the SPV that enters into the various project agreements, so the PPA, the EPC contract, the O&M, which I'll sort of run through briefly later. And it's also the entity which the financing will go through. So why do we have this sort of structure? Why would the sponsor set up a wholly new company? Well, it's to ensure that the project risks are isolated and ring-fenced to that SPV project company. All the financing goes through that entity, and it means that the financing of these, large-scale infrastructure projects is off the balance sheet of the sponsor. You might see a structure where the sponsor also sets up a holdco. This will also be what we call a special purpose vehicle, but it's set up specifically to hold the shares in the SPV project co. And again, this is just it's just to provide another, layer between the sponsor and the project company, and ring fencing the sponsor's other assets from that particular project. So just to summarize, why would we use project finance? It helps finance capital intensive projects and allows us to leverage the project to pay off the debt over a long period of time. Also, it allows sponsors to, the private sector to fund major projects off their balance sheet. Okay, so this is a very simplified version of a sort of typical IPP project finance structure. And I'm going to run through the structure and each of the sort of agreements just now. So in the middle, we obviously have the project company, the SPV, and which is the entity that enters into all the different contracts. At the top, we have the sponsors or the shareholders. They will inject equity into the project company. If there's multiple shareholders, there might be a shareholders agreement under which the various roles and responsibility of the sponsors will be documented, and also the sort of triggers for equity injection, etc., and corporate governance. As we move around to the right, we have the off-taker. So as mentioned in the first session, traditionally, if you built a solar farm, you would have sold all that power under a long-term agreement to the national utility. However, as we're now aware, these markets in Southern Africa are following how they have in Europe, and they're now opening up. So this means that an IPP has a little bit more choice and no longer has to sell solely to the utility, but can sell directly to a corporate customer or to a trader such as GreenCo. So the off-taker could be a utility, a trader, or an ultimate customer. As we move down to the bottom, we have the lender. So there are several different categories of lenders in a sort of project finance transaction. Government lenders, multilaterals, commercial lenders, onshore, offshore, all sorts of different types of financing available. And Orly will speak a little bit on this in the next session. We move around further to the left, we have the O&M contractor. So the contractor will be responsible for operating and maintaining the asset over the lifetime of the asset. Ideally, as an IPP, you would want to match the term of the O&M agreement to the PPA, but often O&M contractors may not necessarily want to, sign up to a 20-year O&M contract. So often you might see the O&M contract slightly shorter, maybe 5 years, 10 years, with a first option to provide a proposal and renegotiate the terms on the termination of that initial term. So then we have the supplier or a supply agreement. This is only relevant if the project in question is, for example, a biomass plant, which requires an input, or a gas-fired power station. So if the IPP is entering into a supply agreement with a supplier, they'll want to ensure that price volatility and the availability of the input is assured through a fixed supply agreement. And that's what the supply agreement basically is. So, and then we have the EPC contractor. So the engineering, procurement and construction contractor, who is responsible for building the asset. They will be required to build the asset in accordance with certain specifications and by a certain deadline. And they will have, the EPC will have to pay liquidated damages for every day that it hasn't met the target completion. The next slide, this basically just summarizes what I have gone over now. The one party that I didn't mention is the utility or the transmission system operator. And whilst you might think that, you know, they may not be relevant in a sort of private transaction structure because the utility is no longer the off-taker, often the utility or the TSO, they're the same entity, they will still participate because they are the owner of the transmission or distribution infrastructure. So if the IPP wants to sell directly to a customer, the IPP will have to enter into a wheeling agreement, as mentioned by Brian earlier, in order to use that infrastructure. Similarly, a trader, if a IPP is selling to a trader, the trader will have to enter into a wheeling agreement to make sure the power gets to where it needs to go. And these are the main project agreements. I've obviously briefly discussed these when we went through the structure chart. The PPA is the most important agreement as it, it dictates how the power is bought and sold. We are going to discuss the PPA in a bit more detail at the end of this session, so I'll leave that out for now.
My name is Orlia Rav. I'm the Managing Director of EMFIN Advisory. I spent the last 20 years investing in energy and infrastructure in Africa. I actually was a developer for a short time, so I do understand what you're going through. I went through all these phases myself. And my specialty is raising debt and equity for infrastructure projects in Africa. We look at funding infrastructure projects in a project finance approach. So I don't know, that probably will tell you my age, but I don't know if you remember this movie, Jerry Maguire. And this is about a football player in the US where Tom Cruise was his agent. And every time he used to call him, he said, "Where is my money? I want to know where is my money for my contract." And I think what I'm trying to aim here, the big difference between project finance and corporate finance is actually cash flows. Everything else that people have put on the chat is correct. It's part of my assessment. But the first thing, as debt provider, we will look at the cash flow available for that service and the predictability of cash flow. So what we usually say in this kind of paradigm of project finance, cash flow is king. If you can demonstrate your cash flow and show me how good it is, then I'm very happy. So first, the big difference for project finance is cash flow. In corporate finance, you look at the corporate structure, corporate guarantees, and others, which not always exist in project finance. Let's go to next slide, please. So when we say bankable, this very mysterious word, what does it really mean? Ali? So this probably kind of will pick up on a lot of the answers we got on the chat. So first of all, and foremost for me, is there a business rationale for the transaction? You can have a fantastic project, but if nobody needs it, and I can't demonstrate stability of cash flow, I will not fund it. So this has to make sense. Obviously, we want to make sure the sponsors and our partners know what they're doing. So we look at what's the sponsor track record, how this project fits into their overall business and how strategic is this project for the sponsor group. So if you're an SPV and it's your first project, I will look at it and say, okay, is this part of a larger program or is it your one-off? So I try to understand how we align, because we all want to be there through the life of the contract, which can be 20 years. Then, as we discussed in previous parts of this seminar, very clear, transparent legal and regulatory framework. We want independent regulators. So again, this comes back to how can I trust the system and make sure that the contracts are clear to everyone, what will happen if something goes wrong, that the decision-making is independent as much as possible. Other is the contract with appropriate risk allocation. I can't tell you how many contracts in my life I saw with not appropriate risk allocation. And maybe at the starting point, it's not an issue. But down the track, when there is a problem, if the risk allocation is not correct, the party that is bearing the risk will default. And that brings to a lot of headaches, a lot of arguments, courts, no payments, and that's not things we like as lenders or investors. Creditworthy off-taker and predictable demand level. So Anna spoke a lot about the new models for IPPs, and it's all about who is going to take the power and how creditworthy they are. Environmental, social, and responsible behavior. If you have not heard about the IFC performance standard, I suggest you look them up, as most of the development finance institution or impact investor would want projects to meet the IFC performance standard. I'll go through them in a second. They are very long, but at least you need to know what does it mean and make sure that you find somebody who understands it very deep in order to add it to your part of your development of the project. A big add-on for us, and I think that's where your strength comes in, is involvement of the domestic players, whether it's investors, lenders, or commercial participant. If you understand the lay of the land, how to do business, and you can lay over the additional issues I just raised in this slide, then you are on the track to succeed with your IPP. So this is the mysterious IFC performance standards. Every project that will be funded, most of them needs to meet these standards. And can we just press enter? And they look at, there's 8 performance standards, and each of them look at one aspect of a project development. And each of this line has a book behind it. I'm not an expert to the level of full assessment, but I would recommend every development team go through the basic assessment so you understand what is needed and you can take the right people. So we look at environmental risk, labor condition, resource efficiency, pollution, community health, safety and security, land acquisition, very important in power plants. If there are resettlement, even more important to it properly. Biodiversity is becoming a more important issue over the last few years. Indigenous people and cultural heritage. Again, each of these, I can give you long stories of what happened in different projects. I think this is where expert advice is needed. Don't put this aside. That's my recommendation to you. Next slide, please. So how do we finance these projects? Next. So first of all, we have 2 parts usually to funding. One is equity and the other one is debt. When we look at debt and equity, the big differentiation is what is the risk appetite. So equity will take higher risk than debt. If you can press enter again. So equity, we can source from family office, private equity funds, DFIs, pension funds, and impact investors. This market is being, when I started my career 20 years ago, there was almost no funders. It was only the DFIs and some family offices. Today, we have a very thriving market for equity and debt in Africa. In debt, we have different sources. The big difference between these sources usually is the tenor and the risk appetite. So if we look at the commercial bank, and I'm looking at dollar funding, if you look at dollar funding, you will have short tenor of 5 to 8 years, except South Africa, where you have a bit longer tenors. If we're looking at local currency, the commercial banks can do maybe 8, 10 years. South Africa can do 15 years. Commercial banks, again, tenor is the issue. They will do 7, 8 years, sometimes 12 if it's in the Francophone Africa, where you have the currency pegged to the euro. And then development finance, the DFIs, majority of financing projects, it's 15 years tenor and plus for IPPs. And then what we see now more and more is institutional investors like Africa Finance Corporation, the Nigerian Sovereign Wealth Fund. And lately we've seen a number of project bonds. One of my funds recently participated in the bond issued by CEC, Copperbelt Energy Corporation, to develop 2 solar power plants in Africa. So what is the cost of funding for a standalone project? And this is just kind of give you the flavor of the cost. Obviously, every project has its own peculiarities, their own different structures, different risks. So, but if you want to get a feel for long-term debt, will be cost of funding, which usually is now so far plus 4 to 6%, can be a bit lower. I have not seen much higher, but for a very, very risky project might be. Mezzanine debt, which can kind of be a buffer between the equity and debt, is usually the rule of thumb is 2 times the senior debt but kind of if we look at numbers, can be 7 to 10%. All of this is very project dependent and depending whether you get blended finance for the project or not. And that's above cost of funding, so above SOFR. And equity, usually it's 15 plus. That's kind of what the aims of the project. And then if we look at the typical structure of equity and debt, the blend is usually 25 to 35% equity. Again, depend on the risk and the project. And the senior debt will be the complementary portion. There is a way to reduce the equity through the mezzanine debt, as I said, depending again on the project, the funders and the risk perception. Usually the mezzanine will not be more than 10%. So that's a typical project finance in Africa.
Thank you very much, Orly. I don't know whether you wanted to wrap up with any last words before we move on.
Yeah, I think maybe what I could say is, when you look at developing a project, it's very important that you kind of set yourself different milestones and understand what you need to achieve for each milestone. And then when you go to outside parties like lenders, be very prepared to know what you exactly want and be able to kind of present your case in order to kind of answer these key bankability issues that I've shared with you. If you could present to the partners, whether it's equity or debt, your explanation to these key issues, that will help you have a much better discussion with them. And try and summarize it in a short memorandum of explaining your contracts, why it's a good contract, what's the risk mitigation, why you are the right developer, what's your track record, what have you done so far to raise additional support, and then kind of put all of this in a summary.
Wonderful. Thank you very much for your invaluable insights. And now we are going to hand over to Vivek Mittal, who is the CEO of the Africa Infrastructure Development Association. And he is going to run us through some sort of key concept of the PPA and why the offtake agreement is such an important agreement. Vivek, can I pass over to you to introduce yourself?
Thank you very much, Ellie, and I'm delighted to be here. Vivek Mittal here. Alex, before introducing, actually, I think just want to re-emphasize the wise words that Orly just shared. Getting the ask right in front of investors is very, very crucial. Now, I'm Vivek Mittal. In the meantime, I'm going to try and multitask and also delighted to be part of this, and thank you very much to Africa GreenCo and Anna for inviting me to do this. I run Africa Infrastructure Development Association, AfIDA in short. We are a Mauritius-based non-profit and a membership-based association. Our memberships are the likes of African institutions such as Africa Finance Corporation, Development Bank of Southern Africa, IDC, Transnet, Sandral, Africa GreenCo, of course, a very valued member, SAP, I remember, the likes of Climate Fund Managers, AV Mola Capital, Inspired Evolution. We are a very tiny organization, but our members are large ones. They account for, we estimate about a third of private sector investments in across the continent. And in that vein, we actually run an accelerator for developers, many of whom will be on this call, I expect. And the aim of that accelerator is exactly what Orly mentioned, is to assist developers in pitching their projects in a succinct, short manner to really sharpen the ask of investors. The other point I'll make before I start, that actually project finance is the price. It comes at the end. It crystallizes. When signatures take place in finance documents, all the construction and the project documents, and money actually flows. That's the end of the journey. There's a lot that goes into project development ahead of that. At the essence of that is a power purchase agreement in the context of energy projects. And this is a little summary, a quick drive through. Actually, I'm going to go through, I've given away. This is a quick spin through the whole process of figuring out your route to market strategy for the power that your project will pursue. That's the key contract that underpins. It's not the only contract, but it's one of the key contracts that drives whether or not financing will be successful. And I named this page to fix or not to fix, trying to channel Shakespeare into project finance. And I'm going to straight away make about three big mistakes that I always tell people not to make when making a presentation. One is cram a lot of information. You see a blank page ahead of you, but in a few minutes, this will be overcrowded. I'm going to cram in what people learn over a 5 to 10 year period after doing multiples of projects. And the second big mistake is not to start with a graph, and I'm going to start with a graph. Now, if I may, typically, if you look at this, x-axis being time up to about 25, 30 years asset life, US dollars revenue on the left, revenue and cost. One of the first outflows for a company is O&M. And it's not always a straight line, but it's relatively predictable for a solar, wind, renewable energy project. Thermal, gas to power, coal projects are a little bit more complex. The next is debt service. In terms of principal and interest repayments on projects. And typically, you'll get a loan tenor of about 12 years plus minus. In some markets in South Africa, you can go up longer to about 14, 15 years. But the DFI community likes to stick around the 12 to, closer to the 12-year mark, but sometimes it could be longer. Now, you can see that that's already adding up to how much revenue you need to bring in. Another important element is tax. And the tax of that's relevant to a particular project usually kicks in from year 7 to 12, depending on what there's capital allowances, depreciation of the investment upfront. Oftentimes, you get tax holidays in certain jurisdictions, and such like. Now, the question is, how should we manage our revenue? So, if we have and we know prices change up and down. There could be some volume risk depending on the project and technology we're talking about. If you can see these bits, when you have very high revenue, nobody complains about it. Everybody's very happy. But the likelihood is that there will be, if we are totally uncovered in terms of contracts for offtake and depend entirely on the market, there could be periods where we are not making enough money in the project to cover our debt service. And that's the problem. That's the straight route to the naughty step. That's, banks don't like that at all. They have to make provisions, often even perhaps taking impairment charges. And typically, if there isn't a clear strategy to market, it's very difficult to recover from a down cycle in revenue and prices. Even if the rest of the life of the project is quite rosy. So this is where everybody focuses. And that is where a fixed price power purchase agreement or a contract or a hedging strategy is highly recommended. And a lot of the effort from pretty much the first desktop feasibility you'll do is at what price can one sell the power for on a long-term basis. So that's the theoretical concept. Now, I said I'd make 3 mistakes. A third mistake is never to talk about complicated formulas. And I'm going to talk about 2 complicated formulas that are very, very relevant to this. The first is annual debt service coverage ratio, which is, as it says, ADSCR, and a favorite word for project finance bankers, CFADs. Do we have the possibility of audience participation right now? I would like to ask who can tell me what CFADs is. If not, I'll carry on.
They should be able to answer questions in the chat. So if anyone knows, please go ahead and respond in the chat.
What does CFADs stand for? Anybody? Cash flow available for debt service. Mr. Shahid Ali, full marks. So CFADs indeed, cash flow available for debt service. And that is basically the difference between this green line and O&M. That's the amount of cash that's available. DS is debt service, principal and interest any one period. Typically for a renewable energy project everywhere, whether it's the United States or the US or Japan or India or Ethiopia or Zimbabwe, Zambia, I think 1.2 times coverage ratio is quite relevant over there. And that's a minimum. And that also reinforces why this gap between the green line and the blue and red line should be at least 20% of this entire amount here. Now that's a constraint that one has to work with. The other one tends to be loan life coverage ratio, and you don't always see this. The loan life coverage ratio is you take the net present value of all the available CFADs throughout the life of the project, divide that by the debt service, and it can be anywhere from 1.5 to 2.5, 2.5 times. That becomes very important if you're going to, and this will come later on, I expect, when we talk about variable pricing in the PPAs. On that basis, moving on, these are the 2 sort of structuring constraints that the financial model has to solve for. How do we get out of this? 1 second, please. So that's okay. So this is my little attempt at humor. This is the whole structuring optimization, and that's why I tend to draw a hole both with and without the W. Is from the point of view of the developer is equity IRR and NPV optimization, right? There are 4 things. There are 4 sort of drivers of equity IRR NPV, and one is of course cost of debt. How much is the interest component of this debt service? And tariff. We all know that. That's very obvious. Who can tell me what are the other 2 that drive this? What are the other 2 drivers of equity IRR and NPV? Indexation, somebody says. Not really. Project cost. Yes, that's right. What else? One more. So discount rate, okay, as a cost of equity, I'll call that a cost of capital, perhaps a 5th one. OpEx, project duration. Well, it's not project duration, but I'll say loan tenor. Now, there's a lot of focus on shaving off 0.5%, 1% of the cost of debt. And actually, if you're an equity investor, your cost of equity is pretty much fixed. you know what your cost of equity is. You're maximizing the IRR against that. It has to be greater than the minimum cost. Loan tenor is a big one. Now, tariff, of course, governments typically want the lowest tariff possible, and indeed, it is a good strategy to aim for the lowest tariff you could provide, because that reduces the payment risk in the future. That creates the security. So it's counterintuitive, but it makes sense to actually aim for as low a tariff as you can offer. Now, and how do you achieve that? The point is, cost of debt is actually relatively inflexible, particularly in the case of African projects. Majority of the debt comes from DFIs, and the DFIs are a very cliquey bunch. They don't like to compete with each other, and they kind of gravitate to a fixed cost of debt very quickly. The most sensitive, if any of you have worked on a model recently, you'll know that if you sensitize for the same tariff, for the same equity IRR, or the same cost of debt, the biggest impact, same tariff, same cost of debt, the biggest impact comes from flexing or reducing, increasing capex. If you can achieve a better price in the EPC, that gives you a lot better outcome in terms of equity IRR than flexing tariff and or cost of debt. Loan tenor is the second best. So if you can see this, if this blue portion were to be extended, one would pay probably on cumulative basis more interest, but your payments per annum would reduce, and then this green line could reduce as well. And there is, not to my surprise, over the last 30 years that I've been doing this, there's not a lot of focus on optimizing capex and loan tenor. There is Mr. Adam Griffith says, and the shaping of the debt swell as tenor. Okay, that's a slightly esoteric comment, but anyway, I'm quickly going to go through one or two of the other slides, and we can come back to this in the discussion if you wish. So general comments beyond this, energy generated by PPA is generally sold under a long-term put. We've gone through that already. Why? It should be legally binding. We should be very clear about the willingness and both the ability of whoever's buying that power over 20-25 years to pay. And a lot of structuring works in a African context. A lot of structuring goes into enhancing the credit of that, and that is really at the essence of one of the key fundamentals of Africa GreenCo's proposition, which we'll hear about as well. The legal obligations, how solid is the contract, arbitration, dispute regulations, and the credit enhancement that we've talked about. PPAs help to overcome some of the major barriers associated with procurement. So it's, we just talked about why, and why, because of the level of leverage and the high level of debt, you want a fixed price rather than a variable price, or as fixed as you can get. Dispatch, take or pay is a big area, and actually that has been a big cause of disruptions, because we have many situations across the continent where the government has signed a take-or-pay contract, or the utility has, but they haven't taken into account sort of ancillary infrastructure such as grid that might potentially delay the offtake. So there have been cases where government has had to pay lots and lots of hard currency, particularly during COVID, the early part of COVID. Ghana had a whole program that failed on that. The point of mentioning this is it's great for investors to have that obligation, but it doesn't always work out how it's written in the contract. So be careful about having too good a protection, which doesn't really help us in the long term. Capacity charge plus energy charge. Yes, I mean, that's how the whole process started. When the first projects were being built way back in the 80s and 90s, the emphasis was on recovering the capital. So there was an annual capacity charge and an energy charge separately, particularly when this came from gas and coal plants. But now I think the world has moved on, and the majority of the contracts are per kilowatt hour, and that's how life works.
and we've talked about the rest, about how debt service and operating costs and taxes, everything that's very important to the good functioning of financial functioning of the company is important, right? I'll say this gently: upward sloping and inflation indexed tariff is far more is much easier to bank and get financed than a flat or a declining, and sometimes you get declining or a shaped tariff where it just falls to a very low level after repayment of debt. A generally sloping upwards line from is much better to finance. Currency indexes are also there, where a country or a utility is going to pay in local currency. So you do see that. The only time you don't have a currency index is when there's a decent proportion of local capital. So in South Africa, I'm currently in India right now on an India and Africa summit. In India, there's tens of billions of dollars, very risky currencies in both markets. But investors, international and domestic, have taken the view that is okay. They can figure out a way of living with it. So there.
Andrew Shaka has mentioned termination payment considerations for single buyer offtake contracts. As part of political risk cover or country risk cover in export credit agreements and/or enhancements from the likes of African Development Bank, World Bank, etc., or AfriExim, ATD.
These are the entities that provide it.
There are, and particularly if the PPA is part of an implementation agreement with the government, there are scenarios under which the equity investor feel they have a right to say, we have done our job, we've built a good project, but the environment, the enabling environment, the ecosystem is not conducive for us to get the return that we want from the investment we've made. And what that leads to is a termination, but at that termination point, there is a discussion on how much compensation should the developer or the owner, the equity investors, how much should they get? And depending on the causes, then you can have, at least, typically at least 2, if not 3 or 4 different curves as to how much profit they're allowed. So there'll be a calculation on the future loss equity returns and the cost of unwinding hedges and things like that. That'll be factored into determining a termination payment. And you see, I mean, the risk, what I've mentioned in this, the risk enhancement or the credit enhancement of PPAs, the hedging, termination payments, they become a discussion of their own. And that can actually just expand the development timelines excessively. It typically takes about 3 times longer. In our accelerator, we have developers who've been at it for about the best part of 10 years in terms of developing their projects for issues such as this. Hopefully that satisfies that discussion. What are the solutions across the markets we've been? So Guy Dixon has a question. What are the solutions across the markets we have discussed that mitigate grid availability risk in wheeling arrangements? Many state utilities are not currently prepared or financially capable to take on. In traditional bilateral PPAs, this is often covered with take or pay capacity payments. Has this ended up being borne by the utility? And so this is right for Anna, and this is right down the middle of what Africa GreenCo are offering, and I think I'll leave that to you to take up in the discussion, because that is an issue. If 2 private entities are entering into a hedging agreement or a direct supply agreement, and you're using the grid to wield the power, it's hard to justify all the take or pay. I mean, for a small fee for the grid to be lumbered with a large termination payment, it doesn't seem fair on the face of it. So that's again part of the structure.
Jan has asked, deemed energy approach, unfortunately, is a concept which utilities do not want to accept anymore. Changing to take or pay clauses makes position of IPPs much more vulnerable. Or you mean take and pay? Well, it's not take and pay. It's really what they mean is we'll pay if we take. And that's a little bit more clunky to say. The take and pay doesn't imply the risk that's actually embedded in that. And the PPA much less bankable. Any opinions from the panel? Yeah, personally, I think grid development should be given a lot more thought than it does. And failing that, there is no real option but to have this. But when you get, let's say, a green hydrogen project contracting for 1,000 megawatt solar plant or a wind plant which is 50, 60, 100 kilometers away, using the power to be wheeled through the grid, a third-party owned grid, possibly a national monopoly. That is going to be a big discussion, and it could land in many. There's a plethora of ways of dealing with that, but that's what people. That's where lawyers and entities like Africa GreenCo and good developers earn their. Shahid Ali says this typical lending rate in Africa for US dollar euro. For example, interest rates are 29% for commercial banks for local currency loans. Question related to 4 to 6%. I'm not sure I follow, but you see, I mean, it goes back to what I was saying. And I would encourage you all to take a spin on your latest financial model you have, and hold the equity IRR at the same level, move the debt by 1%. So reduce the debt from, if it is 10% to 1%, if it's from 29% to make it 28%, and see what happens to the tariff. Move the capex by 10% and see what happens to tariff. Again, you're keeping equity and NPV IRR the same. It is a little bit of, it's complicated to do it, but I'm geeky enough, and I'm happy to admit it, that I've spent a lot of time doing that. Next, move the tenor from 12 years to 13 years, or 15 years to 16 years, or 14 years. See what a 1 year difference makes in the tariff. And what you'll find is that actually it is the loan tenor. The problem that nobody focuses on is, whilst an Egyptian bank might be charging a good 29% as an interest rate, that'll actually wash out the differential from a hedged US dollar hedged Egyptian pounds. Not going to be very far from 29%. But a multilateral DFI might be able to lend for 15 years, whereas an Egyptian bank may not be able to lend for more than 7 years. And it's that tenor differential that kills the ability to get domestic capital. I really encourage each of you to look at that. So there goes. Thank you very much again, and God bless.
Thank you, Vivek. Okay, so hopefully in the next section we might be able to answer a few of the questions that have been sort of arising about the PPA and risk apportionment. As mentioned by both Orly and Vivek, the correct allocation of risk is one of the most important elements in creating a bankable project. And the general concept is that risks should be allocated to the party who's best able to deal with that risk. And obviously, lenders are very familiar with the large-scale sort of utility risk allocation, where the off-taker was the state and the government. However, now we're seeing these new market models, and we might see a slight change in how the risk allocation is going to look. Because obviously, as a trader, you're a private entity, you're not a government, you're not equipped really to take on some of the risks that the government traditionally took on. But just as we go into the next section on sort of, important features to consider in drafting or reviewing PPAs, it's very important to mention this in the concept of sort of reviewing a PPA, because before you even start to review or draft a PPA, you really need to have identified all the project risks and ensure that, one, they are sufficiently addressed in the PPA, and two, they are allocated to the right person. And that's just a sort of general concept that we need to think of whenever we're looking at a transaction document in this. Okay, so I've just set out on this slide some important features to consider when drafting PPAs, and termination. So termination is a big one. It is hugely important for the PPA to clearly set out the scenarios in which the PPA can be terminated. And a lender will typically want to ensure that if there is an IPP event of default or a force majeure, this doesn't allow the off-taker to prematurely terminate the PPA. And why is that important? Well, early termination is a huge risk, because early termination of the PPA means termination of the revenue stream, which is used to pay back the debt. Lenders will want to ensure that there are suitable cure periods that are built into the default process, such that if the IPP defaults, the IPP has enough time to remedy that default before the off-taker has the right to terminate. Ultimately, termination from a lender or IPP's point of view should be a measure of last resort. Similarly, with force majeure, typically you'll see a termination right after a specific period of time. All parties will want to make sure that after a force majeure, there isn't a hair trigger termination, but there is 180 days, depending, it can be whatever time period the parties are comfortable with. Only at that point can the parties terminate. We did touch on briefly the concept of termination payments. And, this is the traditional scenario where lenders expected the government to essentially buy out the project. However, we're now moving to a new model where, the off-taker is a trader. And in these sort of PPAs, what we're seeing is that if the PPA is terminated due to the IPP's default, then the off-taker might agree to a termination payment, but not on the scale of, traditionally that we've seen in these large projects. But it might be between maybe 3 months and 12 months of PPA payments. And essentially the concept being that this should be enough time for the IPP to find a new off-taker. So the idea not being that the whole project is paid off, it's just giving that little buffer so that the IPP can find a new counterparty. So off-taker event of defaults. Lenders, they'll want the IPP to exercise certain rights if there's been an off-taker default. Typically, this will be a payment default. And so in a PPA, the IPP should ideally be allowed to, one, draw on payment security. Two, they won't want the right to sell to someone else in the interim, maybe. It might not be practical, but it's always an option. And then three, ultimately terminate the PPA. But again, as we said, that's sort of a measure of last resort. But we are seeing, people wanting to possibly have the option to sell to someone else within a specific time frame, which is another way to mitigate the payment risk. So change in law. Now, change in law is a bit of a tricky one, because we've traditionally, anyone who's worked on sort of the traditional model where the utility is purchasing the power, the risk of change in law or change in tax has been passed to the government under an implementation agreement or, under the PPA itself. And under this sort of traditional model, the government might have to compensate the IPP if a change in law took place. And depending on how it's drafted, if it's a discriminatory change in law, or there are very many different options in drafting the actual clause. However, depending on how these have been drafted, they have been quite controversial, and because they impose essentially contingent liabilities on the government. And some argue that they restrict the government from developing and changing their own laws. So with the new model, or I'm calling it the new model, with an intermediary or a customer as the off-taker, it's a little bit difficult to work out who is going to take the risk of change in law, because ultimately it's not the off-taker's responsibility. They don't have control over the laws, and it's not the IPP's responsibility. So it basically becomes a shared risk. And in this scenario, typically what we see is that the parties, if there's been a change in law that affects one of the parties, there'll be a trigger within the PPA. The parties will come together to try and negotiate new commercial terms to maintain the commercial intent of the PPA. But ultimately, if they can't agree on those new commercial terms, this might lead to a termination right of the PPA. However, this is obviously a huge risk to the lenders. And they may want the additional protections built into that change in law clause, such that if there's a change in law and the parties can't agree, the off-taker might agree to pay full power for an additional 6 months, or whatever that time frame is, up to a year maybe. And again, it's that concept that this should be enough time for the IPP to find a new off-taker, negotiate new terms, and then the PPA will be terminated. So, and the next one, deemed energy. So I think someone mentioned this on the chat as well. I can't remember quite what the question was, but the concept of deemed energy is that if an IPP cannot deliver energy to a delivery point due to the fault of the off-taker, then the off-taker must pay for such energy, as if that energy had been delivered. And so traditionally, obviously, if the utility was the off-taker, this would cover grid risk. So if the grid is down, then obviously that's in the responsibility of the utility. And so typically in those scenarios, the utility would have been required to pay deemed energy. In a transaction where you have a private entity that's the off-taker, so a GreenCo or another trader or a direct or a consumer, they're not really prepared to take the grid risk because they don't have any control over the grid. That is, that's part of the TSO, its responsibilities. So it's quite difficult for a private entity to take on that risk and pay deemed energy in those scenarios. So what we see is that in that scenario, we might see the connection agreement between the IPP and the utility or the TSO might include certain protections within that such that the utility will pay deemed energy if the grid is down and the IPP cannot deliver to the delivery point. So we're just seeing these sort of concepts come up in different places. They might not necessarily be within the PPA. But as said, deemed energy is still a concept such that if the IPP can't inject because of the off-taker's fault, they'll still pay. Okay, the next one, force majeure. So, I mean, I think everyone probably is aware of what force majeure is. It's a contractual protection that is included in contracts to remove liability for unforeseeable events and unavoidable catastrophes. And it's used to protect both parties from things happening outside of their control, essentially. And typically these include natural disasters and acts of God. So in a private-to-private transaction, force majeure is, is a shared risk. Neither party has control over these things. So the ultimate consequence of a force majeure event will be termination, but that after a prolonged period of time. And lenders will want to see a sort of a considerable amount of time before the trigger to terminate kicks in. Okay, so lender rights. The PPA, whilst the lender is not a party to the PPA, the PPA will need to account for and cater for the lender's rights. And by this, we mean that the lender might have certain step-in rights if one of the parties has defaulted. Also, the lender might have consent rights over the off-taker, doing certain things such as assigning the okay, delays. So as mentioned earlier in this presentation, in project finance, the debt is repaid from the project revenues. and which only obviously start to flow from the commercial operations date. So before that time, no money is flowing. So getting to commercial operations date by the scheduled time is hugely important for all the parties, the off-taker, the IPP, the lenders. Under a PPA, typically the IPP, if it doesn't meet its scheduled commercial operations date, it will typically have to pay liquidated damages to the off-taker for failure to meet that. Okay, I just want to see how we're doing on the time. Okay, right. I was just going to run through briefly two different options of PPA tariff structures. I imagine a lot of you are familiar with these, as we've got a lot of developers on the call. So generally, there's two sort of types of tariff structures. There is the capacity-based tariff, or there is the all available energy or take or pay tariff. The capacity-based tariff is used for dispatchable plants, so plants that have power sources that can be adjusted on demand, gas, large hydro, etc. And the tariff is made up of a capacity charge, which is a fixed charge, and that's paid regardless of whether or not the power is delivered. And then it's also made up of a energy charge, which is a charge that is paid of, the actual metered energy. And so this allows the IPP to cover its fixed costs with the capacity charge, such as debt service, fixed operating costs, and an agreed equity return as well. And then the energy charge will only need to cover the variable operating costs. And then the sort of the take or pay tariff or all available energy tariff is a lot simpler. It's just a fixed tariff for energy delivered and metered, and the off-taker must pay for all energy delivered regardless of whether or not they take it. And if energy cannot be physically taken by the off-taker and output is curtailed, then the energy will be calculated on a deemed delivered basis. So performance security. So performance security, I'm talking about, two types of performance security. In terms of the off-taker, this really is the payment security. And then on the IPP, we're looking at construction bonds or performance bonds, really. So for the IPP, we might see a requirement for a construction bond if, and this will allow the off-taker to sort of claim on that if the construction isn't, the COD, commercial operations date isn't reached by a certain deadline. Similarly, throughout the lifetime of the plant, the IPP will be required to meet certain performance standards, and if they don't, they will also be subject to liquidity, performance damages, and the off-taker will be entitled to claim on the performance bond. And we do see these in the sort of the traditional model, but also in a model where a private entity is an off-taker. In terms of the sort of payment security, as discussed earlier, so that the IPP is expected to be highly leveraged. So with the debt and equity ratio between 60 and 40 and 80 and 20. So if the off-taker is late on paying under the PPA, this can very quickly push the IPP into default on its loan. So it can't pay its staff, can't pay its operating costs. And so liquidity support for the off-taker's payment obligations will typically be required. And what we're seeing is enough to cover maybe 3 to 6 PPA payments, but it depends on the country, it depends on the off-taker's payment history, it depends on the financial strength of the off-taker, and sometimes longer is required. This will typically be in the form of a bank guarantee or letter of credit. And the liquidity support will, probably need to be collateralized in some way. So by this we mean, putting cash collateral, potentially tying up significant amounts of the off-taker's cash reserves in an escrow account, or maybe through a partial risk guarantee structure, which might be issued by the World Bank or similar. But there are other ways of mitigating payment risk, and this includes the IPP selling to off-takers that have the ability to sell to a portfolio of different customers, such as GreenCo. So if we have these sort of different models in the market, it may diminish the need to provide liquidity support as these entities develop and build their portfolios, as they can diversify that risk through their broad customer base. And so I think this leads us on to the sort of the last section, where I'm just going to, briefly summarize, I guess, everything that's sort of gone before with the new market structures and this bankability sections, and a bit about what GreenCo can do. So we've heard a lot about this, traditional model, the bilateral model, where an IPP would traditionally sell to a state utility, and this requires the government to underwrite the utility's obligations, and it puts significant strain on the sovereign balance sheet. And the projects typically required, additional credit enhancement facilities from DFI resources, and obviously DFI resources are limited. It's not an open bank account. So this means that there are, limited credit-worthy off-takers in the market, as the off-taker in most jurisdictions could be the constrained utilities. Not always. Often the utility is very robust, but in some countries, this is what we've seen. And so this means that there are only a few bankable projects. So in order to counteract this, there are new business models required, which is where GreenCo comes in. And so GreenCo, as you probably know, is a renewable energy trader, and we're licensed to trade in Zambia, Zimbabwe, Namibia, and hopefully soon South Africa. Our job as a trader or intermediary is to essentially take some pressure off the utility and be a credit-worthy entity which IPPs can sell power to, in addition to selling to the utility. GreenCo mitigates risk by building a diverse portfolio of IPPs on the one side and customers on the other side. And so GreenCo has a much greater ability to mitigate payment risk compared to if IPPs were in bilateral arrangements. And because, if one of our customer defaults, we can very quickly resell that power to competitive markets or other off-takers in our own portfolio. Not only does GreenCo diversify risk through the portfolio approach, we also have a liquidity structure in place. So as part of the GreenCo model, we commit upfront collateral, which we call the liquidity buffer, which backs our payment obligations. And this means that in the event that we don't pay the IPP, the IPP can draw on that liquidity buffer, and essentially creates an extra pot of cash, which will obviously make the lenders very happy. And I think it might be useful just to sort of summarize why, why do we even need a trader? Why can't IPPs sell directly to a corporate customer, which of course they can. There are just some things that traders or intermediaries can do, which, and we can provide certain services to corporate customers. For example, we can do a little bit of, we can provide flexible PSAs. So although, PPAs tend to be long-term, 20, 30 years to cover that debt, we don't need to, when we're selling to an end user customer, we don't necessarily need to sell on a 20-year basis. We can provide them with a 2, 3, 5-year PSA. And that's purely down to our ability to use our portfolio in a way to create flexible options for our customers. The other reason why it might be difficult for an IPP to sell directly to a corporate customer is that historically buyers have assumed both volume and shape risk that arises from the intermittent nature of renewable energy. So for example, solar, the sun is shining during the day, there's power, there's no power at night. And so this is derived from a typical utility off-taker model where the utility obviously can manage that risk because the utility is buying from a whole load of different generators with different technologies. So they have some dispatchable plants, some non-dispatchable. In the evening when there's no solar, the utility can utilize a pumped hydro resource. And this isn't the case for a corporate buyer who might be buying just from one single solar project. So, you know, if they're buying from one single solar project, unless that solar project has battery storage, the corporate client won't get any energy at night, which is obviously a problem. So as an intermediary, GreenCo can obviously, we have the ability to access the competitive market. We have multiple generators in our portfolio. So we are in a much better position to manage that risk, take on the volume and shape risks associated with variable renewable energy. So we can, you know, match the actual demand profile of our customers, which is obviously beneficial to the customer. So I think with that my presentation actually comes to an end. And I think we can probably go on to addressing some of the questions that we have. I know we've had quite a few questions coming in. So Anna, how would you like to do this? We directly speak to a number of questions, or are we going to respond in writing?
Thank you very much, everyone. I think we have a little bit of time left. Thank you to all the presenters for absolutely amazing presentations. I myself learned quite a lot. Taking into account that we have our guest speakers still with us, and thank you very much, Orly, for that. Could I kindly ask, Vivek has already answered quite a few questions. Orly, would you be so kind to choose some of the questions that you would like to answer? And then we, as the GreenCo team, can also individually answer the questions that we have looked at ourselves.
Okay, so I think one of the questions that popped in the chat was about the local currency costs. And yes, I agree. Unfortunately, local currency costs are quite high because they are pegged to, if you look at my presentation, I always said it's cost of funding plus something. And usually the cost of funding in local currency is the T-bill, or 3 months or 6 months T-bill. And a lot of the local currency funding today is quite high because of the cost of debt in local currency. So even if you get a 2-3% over local currency, which is very, very low margin, even a blended finance, it means that the total cost is high. But what the big issue between local currency and hard currency is actually who takes the risk of FX. So some PPAs are pegged to the dollar, and then you will fund in dollars. And that means that your off-taker takes the FX risk. And if we're looking at private PPAs, if the off-taker is a mining company that sells in dollars, then for them it's not a big issue. But if your off-taker is in the big industrial who is producing and selling in country, then the FX risk is very high for them, and they will go for local currency PPAs. And that's where more ingenuity of how to balance these two risks between the two parties is important. Because if you fund in local currency, yes, you pay higher interest rate, but you can offer a lower tariff, and the FX risk is kind of not borne by at least the off-taker. There's no right and wrong answer. I think it's a negotiation between the parties and understanding the needs of each of them. But one of the ways to get cheaper funding, but that's for operational projects or larger companies with track record, you can place a bond, as CEC done, in the local markets, and that might bring you longer and cheaper funding. So I hope I answered this one. I'm going to allow one of my colleagues to answer a different one, and then I'll see if there's others I can pick up.
Orly, there's one that is directed at you. I've just seen here. I don't know whether you see it.
Tell me which one?
Yeah, it's in the Q&A section, and it's from
Where's
Lucky.
the Q&A section? I only see chat. Oh,
yeah.
sorry. Now I see. Okay.
Yeah, from Lucky Masuta.
Yeah, I'm afraid early stage RE project developers, this is kind of the most difficult segment of the market to be in. usually the way to try and address it is by finding a co-developer with more that has more potentially financial track record or equity. There are a couple of funds in this market that will do co-development, and people are interested in it. But if you're trying to do it on your own, I'm afraid I wish I had a short answer to it. I know there's, for example, big programs today that helps developer go through development stage, like USAID has just launched a huge program in West Africa. I'm not sure about the SADC East Africa region, but there is a program going on for the next 3-4 years where Power Africa will help take projects to financial close through providing advisory, which can be financial and technical. So I think this is one thing to look at. But as I said, the most important, which is in your control, is to try and answer the best you can the bankability issues I've relayed up on my slide, because if you have a strong, convincing story, that's the best foot forward that you can put on your own. I hope I answered.
Brian, could I kindly ask you to answer some of the questions that you will be tackling?
All right, thank you, Anna. There was a question posted by, fortunately, it's anonymous, so we don't know who posted that. But the question was on the critical skill gaps for renewable energy players on the African continent. I will speak to that we have had interaction, particularly in the Southern African region, in dealing with projects. If you recall, in the presentation by Ellie, she did mention the project finance metrics. So it will be from that angle that I will answer this question in relation to two players in particular. First, it is the independent power producers. What skill gaps do we see? Most of the time you will find that the project developers are quite skilled and very qualified in one particular area, perhaps as engineers or financiers, or perhaps they are coming from an investment portfolio trying to enter into a market. Now you find that there are silos of information that these developers come with. They know one area very well, but they do not fully understand or appreciate how these project finance metrics components fit together, the technical with the regulatory, the financing, and how to come up perhaps even with the corporate arrangements of creating an SPV, the financial modeling. So that is something that we have seen. And also is meant, this webinar is meant to make you aware that there are these components which you will not necessarily be an expert in through these webinars, but you will know the relevant questions to ask when you are meeting with the various players in trying to structure your project. So that is the first part. IPPs sometimes lack a comprehensive understanding of the project matrix. The second one are regulators. You will notice within the presentations, we've mentioned that there have been quite a lot of changes in the regulatory frameworks within the Southern African region and even across the whole African continent. A lot of these laws have been passed, requiring a crystallization of the steps right down to the level of regulations for the players to enter the market. Sometimes there are some gaps in information, and whenever there are gaps in information, you find that regulatory risk comes in, and whenever there is some risk in a project, it may put a halt to a financier going ahead to finance a project. So regulators need to understand the project matrix as well, particularly from the impact that their regulations have on a project developer. A case in point would be an issue of what comes first, the license or the financing. A regulator will tell you, can you get the financing? Then we'll give you the license to operate. When you go to a financier, they'll say, well, show us the license that you have permission to operate in that jurisdiction, and we'll give you the funds. So a developer is now caught between chicken and egg issue, and it takes time to resolve those points to arrive at a place where the project can move ahead. So that creates regulatory risk, and any risk will delay project. So that's what I would say about that.
Thank you so much, Brian. Ellie, perhaps over to you now. Thank you.
Yep, sure. So I've answered a few of the questions on the actual sort of Q&A, but I'm going to answer a question from Adam Griffin at the moment. So the question is, in an African context, contracting with utilities, how much alignment do you see to the bankability standards of the World Bank, African Development Bank, and Power Africa? And what are the key bankability considerations do you see outside of the creditworthiness of the state utility? So to be totally honest, I don't, off the top of my head, know exactly what the bankability standards are of the World Bank. However, I would imagine that they are prepared on the basis of the traditional structure where the utility is the off-taker. Obviously, as we're moving to a different, and just to summarize, the sort of key bankability issues that we would see is quality of revenue certainty. I know we've discussed this lots. I mean, it's not necessarily the creditworthiness of the state utility, but it's the predictability of the cash flows. Long-term offtake agreement, well-structured, clear PPA. Lenders will also look at the quality of the counterparties, the experience track record of the EPC and O&M contractor, for example. Because ultimately, if the project never gets to COD and they've invested huge amounts of the financing up until that point, that's an absolute disaster, because, you know, only at COD does the project start generating and start paying back the debt. And then the other sort of key bankability issue is obviously the correct allocation of risk. And we've discussed that in a sort of high level way, but like, you know, is the risk allocated to the right person? And in a traditional structure, as I said, the government can take on certain risks that a private party can't. And so we're going to see a change in the allocation of risks from what lenders have traditionally seen. There will be a change in PPAs where the off-taker is a private entity, because the private entity just cannot take certain risks that the public sector can. And so I'm not sure that particularly answers your question, because I'm not super familiar with the bankability considerations of the World Bank. I don't know whether Orly is still online, because you might have a better idea. Do you know, would you be able to, I mean, do you have anything to add to this question? So it says, the question is, in an African context, contracting with utilities, how much alignment do you see to the bankability standards of the World Bank, African Development Bank, and Power Africa? What are the key bankability considerations or failures do you see outside of the creditworthiness of the state utility?
So I think if we look at bankability with the kind of the IFIs, we need to bear in mind that we're looking at two parties. So World Bank, as World Bank Group, doesn't really finance private sector, but they will decide whether if there is a government guarantee or some sort of credit enhancement, they will have their own decision making on whether to provide credit enhancements through MIGA or PRG for the to the utility or the project. So, and that's kind of it's more the public arm of AfDB and World Bank. Power Africa doesn't provide funding. Power Africa facilitate programs and might do advisory. So that's a completely different angle. They might help prepare PPAs to a bankable, but that's not something that you can cut across Power Africa projects. If we look at the private arms of AfDB and IFC, which is the IFC for the World Bank, they will follow more or less the same bankability issues I've raised with you. So, and I think what you should maybe bear in mind, I spent my last 20 years funding projects with DFIs or on my own, like with my funds that I was managing. The bankability list is not changing much. What is changing between organizations is the perception of risk. So if I say I want to see credit-worthy off-takers, one would say I will deal only with, I don't know, AAA off-takers, which exist very few, and others would say I can live with BB off-taker or higher risk off-taker or lower risk off-taker. So, and that's very difficult to predict because it depends by country, by contract, by sector, and who is actually your off-taker. If we look at the public utility in Africa, I might give you one example of how the market have changed significantly over the last 20 years. One of the first IPPs in Africa was a project called Tsavo in Kenya. When it was funded, there was a government guarantee, there was a collateral account in order to make sure there will be payments. So it was like belt and braces. After a few years, the next round of projects went to market and there was only government guarantee. So lenders were convinced that now KPLC was a better utility than they thought, and they have decided not to take a collateral account. And when I say collateral account, I mean all the payments from the major clients would have gone to this account, so the cash would be in a kind of locked box, and from there you will pay the lender. So this went off, stayed with government guarantee. Another round comes in, and each round like this is about 5 years of development. And then the government said, rightly so, we have a good track record, not interested in government guarantees. So there was a letter of comfort and saying that if things will go wrong, we acknowledge it's an important project for us, and we will do what we can to support you. Not a guarantee. This was just acknowledging the importance of the project. And now there's not even a letter of comfort. You take your own view on the ability of KPLC to repay. So there's a huge move from what would be like almost a Fort Knox security type to have no security in the sense from governments. And this reflects how the bankability of that particular utility has changed over time, and it's also moved towards other utilities in the region. Would I fund all the utilities with no government guarantee? I can't answer that. It depends on the project. I hope I answered.
Thank you, Orly. Oh, hi, Ellie. Which DFIs recognize GreenCo's PPAs? So GreenCo is actually, I mean, a number of our investors are DFIs. So we are, at the moment, the GreenCo model, as it were, is recognized by InfraCo Africa, which is part of the private infrastructure development group, and also IFU, which is the Danish investment fund for developing countries. So there are our shareholders, and they provided our sort of initial investments back in 2020. So they obviously have, a lot of faith in the GreenCo model. We're also looking at doing some work with GreenCo, which is also part of the PIDG group, the private infrastructure development group, and also DFC, so the Development Finance Corporation, which is a US DFI. Ollie, I see your hand is raised.
Yeah, I think to the best of my knowledge, but correct me if I'm wrong, I think EIF was willing to fund projects with the GreenCo model, and my previous fund, which is called FADE, the Facility for Energy Inclusion, also was willing to look at the model and kind of consider, again, when I say willing, it means that we believe in the model, but obviously we need to look at the details of each project.
Yeah, no, absolutely. Thank you. Okay, so I'm looking through, and I think there's one more question which was for me, which is about whether the GreenCo's PPA is a take or pay or a take and pay. And to be honest, I've been working on PPAs, well, I'm not as experienced as many of our speakers, but maybe the last 7 years or so, and I still struggle to differentiate what we mean between a take or pay or a take and pay, as conceptually, they're essentially the same thing. But all you really need to know is that GreenCo will pay for all energy delivered to the delivery point. So any energy that's delivered by the IPP will pay for. There is one question at the end, which might be for a BD question, from Jan Pilar. Any tender by GreenCo for small hydro in 2024?
Well, I was thinking about the question on AI, and I have to say that I would not be surprised if the near future we will have an AI-enabled information on grids. It's quite likely. And again, I'm not the expert to develop it but I've looked at some application on that to see how you can machine learn from the behavior of number of projects, and that actually does help to understand better the credit worthiness over time. So I would say stay tuned to that area, and I wish I knew how to do it, but not my expertise.
Basically asking if we can engage. So I think you have our contacts, or our contacts can be shared. If you want to engage on your project, would be more than happy to.
Okay, so I don't know whether we are, I think that we're going to bring the Q&A to an end now, and I think we might be able to address some questions after directly with the participants.
Yeah, I dropped my contacts in the chat, and I think when we share the slides, we will add my email, and if you have further requests or questions, please drop me a line. You can also find me on LinkedIn. Chat through there.
Absolutely, thank you. So I'll hand over to Anna to close the session.
So thank you, everyone. This was absolutely amazing in my view. I learned a lot myself. You never know enough, actually, in this world of project finance, long-term planning, bankability, renewable energy generation, new market models, interface between regulatory, bankability issues, etc. So it's an extremely exciting time. We've concentrated on some of the risk allocation with GreenCo as the off-taker, but it's very replicable to generators selling directly to customers. And some of the project considerations are also replicable to a generator selling to a utility or other buyers as well. So please just note that everything is, context is key. And as Aurelie was mentioning, each project in its own light has to be looked into. So we hope we have contributed with this first webinar, and we very much look forward to other webinars going forward. I also noted that there are many comments and suggestions to create a forum or group where this conversation can continue. We will look into that, and we promise by the next webinar that we will come up with a solution. We already have everyone's email addresses from the registrations to the webinar itself. So perhaps the easiest will be to organize a Teams group whereby we can also place there the relevant presentations and the recording of the webinar itself. Once again, thank you very, very much. And we are very honored to have such incredible speakers who have led the development of numerous projects in Sub-Saharan Africa, such as Aurelie, Arav, and Vivek Mittal. We are extremely grateful. All of this process of these webinars is really our contribution to the capacity building, especially for local developers, as I mentioned at the beginning. Usually this type of webinars and structures and courses are come at a fee, and we thought that that's sometimes quite prohibitive for local developers. Therefore, if you have any other questions or suggestions for us on how to further improve the content, please also don't hesitate to contact us. With the next newsletter that will come out announcing the second webinar, which will take place next month, you will also get to see the contents of all webinars going forward. And we also take note of the request for certificates. We will also be working on that to ensure that we can provide, we are not an educational institution, just to make that very, very clear. We are a power trading entity and are doing this as part of our corporate social responsibility to help build up the understanding and know-how across all of the players. So, but we will do what we can do following from our perspective. We just have to look internally and check our governance structures to see what we can do when it comes to that particular request. So once again, I can also see that some questions are being raised on the contact details. They will be all shared with you, but I can see that Orly already shared her email, and Vivek, who I believe had to leave the chat, perhaps hasn't shared his details. So someone from my team kindly share on the screen Vivek's email as well as those of the other speakers from the GreenCo team. So we are 10 minutes ahead. And Orly, apologies, did you want to contribute?
Well, I wanted to say something that, 10 years ago, more or less, I met Anna with this idea of GreenCo. And I have to say that I want to really say how much I admire her and the team for taking this from an idea to an amazing reality. I think this is kind of the type of people we need in these markets, innovative and visionary and very, very perseverant. And if I give anyone an advice, if you really want your project to succeed, you have to persevere so much and never lose faith. What we say in the PPP model is a lot of patient. And yeah. So I just want to say kudos to Anna and the team. This is not like obvious that you will have a GreenCo in this market without people who have kind of fought really hard.
That's very kind of you, Orly. Thank you very, very much. And I should also like to thank the rest of the GreenCo team, the happy people of GreenCo, as His Excellency, the President of Zambia, named us recently, and we are delighted to be able to contribute and also to thank all our stakeholders. We wouldn't be here without them. Usually there is a little bit of conflict, sometimes I think mostly perceived, between the private and the public sector, and we can absolutely say that without the public sector support that we have received, we simply wouldn't be here today. That comes both when it comes to state utilities in the region who have embraced us, but also the governments in the countries where we operate. So it is a true example of a model that has been born through a public-private partnership. So once again, on that note, thank you very much, everyone, and we look forward to seeing you next month. So details to follow in our next external newsletter. Thank you.